we'll do a poll. So, Andy, do you envision yourself as the skipper, the professor, the millionaire, or Gilligan, Andy?
Good question. I think I have to be the professor.
And I'll be Gilligan today, George.
Okay, Rob, you can be Gilligan. That's great. Oh boy, another day in paradise. So, you know what? We're just going to get right into it. And I have to say, Andy, this is going to be quite a big space if people actually show. I see we have 250 people already in the room, and they're not here to listen to me. It's obviously testimony to the huge following you have, and influential you've become. In when Andy Constan speaks, I listen. So I think we had, I don't know, 390 people pre-registered for this or something like that, and I'm not going to hold this against you, Andy, because they didn't make a movie about your life. But the only space we've had in the last year or two, it's been bigger with pre-registration, was I think it was Steve Eisen, but you can't compete with that. So I mean, maybe if they make a movie about you, it'd be a fair play. But anyway, Andy, it's great to meet you this way. Um, I guess everything's fine. It's fine. It's not fine. The tariffs are on. They're off. But that's really kind of the shiny object that's, I think, distracted a lot of people's attention. Obviously, there's plenty of uncertainty in the market, but there's a lot of other stuff to talk about as well. So, do you want to just kick it off? I don't know. You want to say something? I mean, if you have a strongly held conviction, a variant perception, or you just want to trigger me, or I can just go with questions. But Andy, I'm happy to turn it over to you.
Okay, sure. So thanks for having me on. It's great that everyone came and is humbled by the number of listeners we have. I guess I should start with the islands, which is trying to describe what I've been talking about for a number of years now, which is we have, there are three basic stances that are really been the market narrative over the last few years. One has been the recurring recession island, where people expect whatever has happened in the past to again occur, where either a financial breakage occurs, or uh, the economy turns over for whatever reason, and we end up with a classic end of cycle deflationary recession. And that's been popular over a number of years. There's been times when people have been very convicted on that. I've really never had that view for the entire time since COVID. And I've been on higher for longer island, and that's a island where the Fed is raises rates and doesn't control inflation, and an income driven cycle, not a debt cycle, causes the economy to stay strong for a long period of time, the economy to stay higher for longer. And that tends to be good for stock prices. I was very bullish at the beginning of in the April of COVID, and stayed bullish until the Fed unleashed quantitative tightening, but regardless, have remained of the view that the Fed had not killed inflation. And so monetary policy was going to stay higher for longer. And that's continued to play out. They have cut, but it's not clear that they're going to cut more, and it's possible they could hike, given inflation dynamics. And then, of course, where everyone has wanted to go is soft landing island. And by and large, the market participants have been rewarded by that view that a soft landing was going to occur, but not in the bond market. And so those are the three islands, and they're separated by a economic slowdown C and a Goldilocks Strait. And higher for longer island, well, actually, recession island also has a very small portion of it that is what I'd call a stagflation cove. So when you look at all of those, that's the way I think about the um, potential destinations for the economy and where we are.
Yeah. So, Andy, the way you put it, you said everyone wants their soft landing. Everyone wants to be on soft landing island, or another way, I've said the same thing. It's like everyone wants their 2024 back or whatever. It's like, Abby Jessicone, please call your office. We want the immaculate disinflation, blah, blah, blah. But it was such an aberrational period. And so I guess, you come to as Yogi would say, come to the fork in the road, take it. I mean, in one direction we see inflation in this, the other one, bust, whatever. But and we keep recycling narratives. I mean, it's wash, rinse, repeat, the same thing again and again and again. And so somehow, though, I just think I question how long we can keep going between these narrow shoals without crashing into something.
Right.
And so if I would say to Andy, we're gonna hit something. All right. Which direction would you be leaning? Am I to infer from what you said it's more the inflationary bond market revolt side of things?
So no, I am. So in January, I left Higher for Longer Island and headed off toward Recession Island. Slowly in the economic slowdown. I expected GDP to fall versus consensus, but not have a recession. And that was driven by two things. One, the Fed had stopped cutting and had indicated that they were on pause for the foreseeable future at a level of interest rates which by and large is not super tight, but also where the short end of the yield curve is having a limited impact on asset prices and the economy in this day and age versus in prior environments. Um, and yet also, once they started their cutting cycle in September, the long end of the yield curve had steepened a lot, and not just steeper, but higher long-term bond yields. And I thought the combination of those two things would start to bite into the economy. It's been a long period of time when interest rates have been higher, and the policymakers have regularly eased, including Powell, in with any or at least given forward guidance that they intended to ease um, when there was any hint of weakness. And Secretary Yellen has refused to term out the debt. And so I needed to see higher interest rates on the long end to start doing its work. And I believe it began to do its work. On top of that, President Trump, who was on inauguration, stocks peaked for the year so far. They've yet to recover that inauguration high. Um, and bond yields steepened further, um, had what was clearly a very different policy than he did when he was president in 2016. In 2016, I like to call him a Dr. Jekyll policy, in which he was really cheerleading the stock market, cutting taxes on corporations, uh, and really not doing much cut immigration, but really not doing much to slow the economy at all. And we had a long rally during that period of time from 16 multiples to 17, 18, even 19 multiple. Um, and interest rates were very low for that entire period of time. And so when he took office this time, I saw his policies as being Mr. Hyde, in which he was going to uh, be even more aggressive, shrinking or not allowing the workforce to expand via immigration. um, Doge, which turned out to be nothing, but at the time was going to significantly reduce expenditures to the greatest fiscal tightening in my lifetime. The reconciliation bill was expected to, be somewhat more difficult to put through given the congressional realities, but result in some Medicaid expenditure cuts. That ended up being true, but it was offset by tax cuts. And all of these factors are heavily anti-growth. And then, of course, he appeared to have a desire to reshape global trade, and in so doing, that would be it could be in the long-term interest of the United States, from a national security interest, from a onshoring production, so we don't have a COVID crisis in the future. All lots of good reasons, but was heavily anti-growth. And so that policy stance, there was some pro-growth stuff, deregulation, which we've yet to see, but that combination of things made me quite bearish on stocks, bullish on bonds, in particular short end bonds. And I was able to ride that to the lows in April. Since then, Mr. Dr. Jekyll has reappeared, and now the courts are going to make it more difficult to enforce tariffs, but Trump had already significantly backed away from his aggressive Liberation Day tariffs. The Doge thing turns out to, based on the rescission bill that's being crafted, looks to be a total of 9 billion, hardly anything, of cost cuts in 2025, and the reconciliation bill, while still cutting expenditures fairly meaningfully, um, front loaded tax cuts so that it was deficit expansionary. And all of those things are pro growth. Immigration, still pretty heavy anti growth, but all those things relative to expectations, certainly, particularly tariffs, were pro growth. And so we got a stock market rally and a bond market sell off. And here we are today.
God, so many threads to pull on here. I'm not sure where to go. So let's start with bonds because I'm consumed by the bond market. I understand from being a regular reader of yours that you expect bond yields to go up. If I got it correctly, I see from the other day you were, I think, calling for from the 27th the other day. You were calling for, was it 5.5% 30 year? Did I read that correctly?
Yeah, yeah. I'm the long end of the yield curve to me is no touch. I can't. I'm not short it. I'm also not long it, and the reason is um, the inflation is yet to be killed. Even if tariffs go to zero, that actually makes the longer term inflation a greater risk to me.
Right, right,
While because you won't have the growth slowdown that tariffs would have caused.
mhm,
And so inflation isn't dead. Term premium is still well below historical norms, and the world is awash in long duration treasuries, both domestic and in their own markets, and U.S. treasuries, and has limited capacity to add to that without the curve steepening and the expected return on cash being attractive, and it's just not yet. So that,
right.
along with the Fed um, likely changing their reinvestment policy, which is a sort of a twist, a QT twist, and the Treasury, Secretary Bessent was and Chairman of the Council of Economic Advisors, Marin, were both very aggressive, talking about how Yellen had manipulated issuance by focusing on bills. So they may do Yellen 2.0 if they need to, but they had promised to extend the debt, and it's unclear whether they will. But if they do, that'll put more duration in the private sector. And so
Yeah.
I just can't own bonds here. They will rally if we have a market slowdown. And I do think we may have a market slowdown. And so they may rally and never hit 5.5%. But if they do rally, 2 year notes will perform much better on a duration adjusted basis, because they currently are only pricing in a very modest cutting cycle.
So I had the privilege to listen to Michael Howell's monthly conference call the other day, and on the point you just made about the term premium, and I was looking at some pictures, some graphs that he showed, and it was really striking. So I couldn't agree with you more. So Andy, let's. I get what you're saying. On the one hand, you get a recession, yields will go down. On the other hand, I get they could go up. I get that. So let's turn to equities then. So as and people always, and I've said this for years. I keep quoting it, attributed to Yogi Bear, but it's actually Niels Bohr. I just looked it up on the internet. Yogi's attributed to having said, predictions about the future. Predictions are difficult, especially about the future, but more specifically, it's the famous physicist Niels Bohr. Prediction is very difficult, especially if it's about the future.
Right.
So instead of trying to make the prediction, let's talk about. And I'm sure you think this way as well. Let's talk about what's priced in the markets. And you could say I like bonds, I don't like bonds, I like stocks, I don't like stocks, but it's a question: what wagers, what odds is Mr. Market offering you? All right, and I look at equities, and I don't see a way to win a lot. They don't have to go down necessarily, but to me, and I could be totally wrong, sure won't be the first time nor the last time. The risk reward doesn't seem to be terribly favorable. That a lot of good stuff is priced in, and so as you look at markets, whether it's bonds, stocks, currencies, whatever, I mean, let's start with stocks. I think most people in this room like to look at equities. Where does that leave you on the equity market?
Right. So I had the good fortune and planning to be very short and made my year and covered at very attractive levels. And I've begun shorting on a scale on the way up again. And I'm now quite short. So that's how I'm positioned. But at the same time, I can paint a fairly bullish case for equities. And so why don't I try that first, which
Okay.
is um, the economy is doing pretty well. There isn't any sign of the economy turning over. The labor market is going to remain tight. The the That'll allow wages to stay fairly strong on both a nominal and a real basis. That'll allow consumption, and that will allow growth. The I don't think that. Well, let's just say this: the deficit is corporate margins, and so a growing deficit could increase corporate margins. That's a positive because the deficit looks like it's going to be growing. Um, the supply and demand of equities has been a long term favorable supply and demand in that wages have created savings and savings have created investment, while stocks have really not increased in share count. And the major stocks are like Apple and Google are reducing their share count. And so the question becomes, where is the supply going to come from? And we can look in the past when markets were frothy, you saw a lot of IPOs. There was the SPAC thing in 2021 too. Um, you see issuance, and you're not seeing that. That means that the private equity market and the private credit market is seeing adequate inflows to allow private companies to stay private and not float equity in the public market. So, from a supply and demand side, the, there's this a perpetual imbalance. Um, the so that's it. That's important. Um, Equities are growing their earnings, while equity earnings expectations are very high. Next year, the next 12 months, earnings are expected to grow by
Hmm.
consensus estimates by around 11%, 10.5. That's pretty high, particularly if the economy is not growing, like it is forecast to not grow. But they're actually earning that growth, meaning earnings are growing every day at around 7 or 8% last year. And so that creates a positive tailwind for equity in price increases. You have AI, which could be a continued positive theme for equities. Um, and now you have lower tariffs, which will help retailers with their margins. Um, and so, and then you have what I would say is a fair amount of short term momentum for equities.
Sure.
So when I look at all those sort of things, I can paint a bullish case for equities. And um, I don't think it's valid, but I do think that is the bullish case.
Right. Andy, how does the dollar? I've used this myself. I'm curious of your opinion. How does the dollar factor in this? A, what do you think the dollar is going to do from here? I'll throw gold in as well. Let's talk about the dollar for a little bit. How does it change? I mean, obviously it helps corporate earnings. Perhaps maybe it's not so good for 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 bond yields. But how does the dollar impact your thinking at all in terms of what you've laid out here so far?
Right. So the dollar, to me, has many different um, um, reasons for it to change in value relative to various things. As it relates to gold and crypto, even crypto recently, gold's up 23% this year, and Bitcoin is up 13% this year. The dollar versus fiat, Dixie, is down 8.5%. So some of the hard currency rally has been dollar weakness, but because dollar is weak versus other fiats as well. So obviously there's an idea of of hard currencies versus fiat, which I'm not going to tackle right now, but we can come back to. What I think is more important regarding fiat currencies as they trade is the outlook for assets in those countries tends to be far more important than the trade related flows that occur between currencies. Trade related flows set a long term trend. And generally, when the exporting country's currency appreciates relative to the importing country, which you would think would be bearish dollar, but in most of these exporting countries, they have artificially maintained their currency at cheap levels by buying U.S. assets. And so generally, but trade flows tend to be very slow moving. What really moves currencies and what's moved currencies lately is capital flows. And capital flows globally to the place, people like to say this, the place that treats it best. And when I look around the globe, particularly in the developed markets, but even some of the EM and even China, the monetary policies of the rest of the world are more attractive for assets, meaning it's easier monetary policy, and the and that that helps assets of all sorts. And the fiscal side is more expansionary in many countries. And so that's a better place to be an investor. And global investors well, forget global investors. The market portfolio is heavily composed is heavily weighted relative to any sort of history in US equities. And so
Right.
that means that for U.S. equities to stay where they are, the inflows into U.S. equities have to match their current proportion. If we're 70% of the global equity market and only 69% of new money gets saved in the U.S., you have a negative for U.S. equities. And a combination of this overweighting of both bonds and stocks in U.S. assets um, is beginning to wear on global investors, and when they look at the relative attractiveness of their local market, there is an alternative, and they're returning home, and that has a
Yeah.
currency impact.
Yeah, for sure. And again, money going home, given the trillions of dollars that's come here in the last 10, 15 years, if just a little of that goes home, or the money stops coming here, and we keep running these big current account deficits, it could be problematic. Michael Howell wrote something, I remember a few weeks ago. We had him, and he was saying, the U.S. may or may not win the trade war, but more importantly, in his opinion, he was going to lose the capital war, and I think that's what you're saying as well. And so I'm not sure people fully understand what that means.
Right.
Andy, we could keep going. I got a million more questions for you, but I want to make this. inclusive. I hate using that word. But before we go to anyone in the room, Rob, did you want to weigh in on something? Rob Isbitz, did you have a comment or question for Andy?
Yeah. I mean, a few different directions, but I'll stick with the last one. So first, great to speak with you. And I actually just interviewed Gina Martin Adams from Bloomberg on a podcast a week ago, and the two main issues that she came up with were exactly the same two that Andy just talked about. One is the idea of companies essentially skipping the IPO phase because the big guys are buying them out. So I'd love to hear just a little bit more on that. And the other is the uh, move away from the U.S. Back repatriating money, which could strengthen a lot of these lower valuation country non-U.S. investments. Um, so I'd love to hear just a little bit more on those two, Andy. And at the end of the day, people haven't looked at small caps international, but this story has been this way for a little while. What makes it actually get from prospective to something you can monetize?
Yeah. So as it relates to the private equity and private debt, um, capital flows, that's not really my lane. I only look at what comes to market, and nothing is coming to market. So I guess what I would say is that as it relates to supply and demand of equities, it's possible there may be an overhang, but as yet we're seeing no developments of it. So I consider that a relatively bullish outlook. Um, so that's what I have on that. As it relates to the currency markets and attractiveness of foreign assets, you have to look at each asset. If you go to Japan, their 30-year bond yield and their 40-year bond yield has massively spiked. And when you compare the fully hedged return of holding US Treasuries in yen versus JGBs in yen, JGBs are a much better deal at this stage, substantially better deal. The problem is that, no one wants to step in front of a train, and so until the JGB yields can support their own are outright cheap, which they seem fairly cheap nowadays, relative to the front end of the curve and the economic conditions. Those flows aren't happening much, but they are happening. If you look at um, the outperformance of, you can look at um, eh, the U.S. equity market versus the equity market ex-U.S., and you'll see 500 basis points of outperformance. Now, that's got the currency exposure in it, so part of that is currency related. Um, when you look at the bond market, the nominal government bond market, same outperformance, and even tips are outperforming in these countries, and that tells me that there is. We came talked about this earlier. Um, all of that is confirming capital flows, because what's happening isn't, hey, the growth opportunity in Europe is good, so buy European stocks, sell US stocks, but also sell European bonds and buy US bonds. Those would not have a net currency exposure if it was a growth impulse. But because it's all assets are improving, that tells me um, it's a valuation change where people are looking at risk premiums in the US versus risk premiums globally, and believe that risk premiums globally are more attractive. So I think it's happening and will likely continue to happen. These things tend to be multi-year trends. And given the overweight, I think it's a headwind for US assets relative to the rest of the world for a while.
Couldn't agree with that more, Andy. I just think, people, it's been so easy to ignore foreign markets. I'm talking about equities now, I'm primarily an equity animal. just because the U.S. is outdistanced those markets so handily. And I cut my teeth on foreign stocks, and so my joke was always, in recent years, like, why, if I can make or lose money between 9:30 a.m. and 4 p.m. Eastern time, like, why do I have to be up at night watching the Nikkei, or up early in the morning to see what the DAX is doing? So I just, people, it may be my own personal view, for what it's worth, is, we don't have to have a bear market here, but I just think that U.S. equities relative to everything else is just not the place to be.
Well, I mean, you have to
And
recognize what's happened. If you
yeah, I
made
mean,
if you
we're
made the
yeah,
decision to stay in U.S. equities, particularly big cap U.S. equities, you crushed it for the last 5 years.
100%. And they always talk, Andy, about how the recency bias. We all you can get complacent about it and lazy about it, and it's all good things. They never come to an end. So I don't. I think we're in a brave new world, but there's just it's such an interesting time, such a challenging time.
But you have to also
So
remember,
Robert,
George, I think the important thing about foreign assets is you and I think about portfolio management I as not just putting all your money in one basket, the U.S. equity market.
mm,
I like diversification. I like diversification in bonds. Until very recently, going to a foreign market to buy foreign equities left you high and dry
yep,
with
no,
regarding diversification because their bond
yep,
markets traded with zero yields. So,
yep,
what I think is
100%.
particularly important about what's happening now is that global bond yields are an alternative to US bond yields, which allows an investor to own diversified rest of world asset portfolio instead of just betting on growth.
No, that makes sense. Makes a lot of sense. All right, let's keep it moving here, because I got a big room and I want to work other folks in. So we're going to go to Anoop first, and then Nasik. Anoop, please unmute yourself. Do you have a question for Andy, Anoop?
Thanks,
Yeah.
George. Thanks, Andy.
Yep.
Big fan of your 101s. I'm still not sure why you haven't published a book about it, but I'll wait for it. So I work in tech. I am. My question is more towards. We see AI is adding productivity. I can clearly say, and I can also feel the layoffs that are happening. Most would be permanent. Some of the roles are going to go away. So we see the productivity gain. We see the tech earnings would improve because of AI, but then the unemployment will also increase, and a lot of the roles, a lot of the white collar jobs will be gone. So in short term, I see it is bullish for Nasdaq. But what is your view on the long term? How it is going to impact the broader economy? Uh, I
Anup,
see people
An-
already.
Anup, I try not to um, think like big thoughts about the future, multi-year future. And you're really hitting on that particular topic. I don't know how it's going to play out, but the dynamic you say is accurate, which is to the extent that AI replaces jobs. By the way, technology has always done that for centuries. Productivity enhancing technologies have reduced jobs. Um, that'll happen again, and somehow we'll end up with full employment, hopefully. Now, that'll change the nature of work potentially, but there is an outcome in which humans find the next thing to do that AI can't do. And so that's one possible outcome. The alternative is um, we don't find the next job and we start having more joblessness. Joblessness has all manner of psychological issues, um, population issues, so many different things that are hard to make a judgment about. But they do then bring up the idea of some form of the term people use is universal basic income, some form of taking money from somebody. You can either borrow it or tax it. Maybe it's taxing these companies that don't have workers, and using it to pay people who are unemployed. And so that wealth transfer is complicated and political and um, fairly anti-American in terms of our culture, um, but is something that is possible in the event that we cannot recreate ourselves in terms of our ability to stay employed in the face of AI.
That's great. Anoop, thanks for the question. Gnostic, my friend, welcome. Good to see you. The floor is yours. Please unmute yourself, Gnostic.
Oh, sorry, I missed the front end. So whether this was covered or not, I don't know. But Andy, what do you think of the fund flows, basically into or out of the United States?
Ah,
Is money still coming in from Europe under war
Well, I did.
theory, or
Well, I did cover that fairly extensively earlier, but I will add a nuance to that. And one of the nuance is that um, the trade balance is at risk at this stage in terms of if the Trump administration does reshape global trade and we have greater onshoring of industry, um, that will and the trade deficit falls. The trade deficit is a capital surplus, and the capital surplus gets invested in US dollar assets. So, to the extent that the um, trade deficit does in fact fall for whatever reason, does in fact fall, that should slow inflows into the United States. I covered more broadly the idea of where investing is more attractive, and I think there are many alternatives to US assets at this stage that are attractive, which will create capital flows. But the trade flows will depend on how the Trump administration manages through this trade conflict.
Thanks for the question, Gnostic. So, Andy, life is not linear. The opportunity set's not always the same. Sometimes, use the baseball analogy, it's a meatball change up coming right over the plate, and you just want to swing for the fences. You may miss, but it's an awfully good pitch to it, right? Other times they're painting the corners, and it's like, damn, all right. So it's kind of like the market. Sometimes there's a lot to do, or there's appearance of a lot to do. And other times it's just you just can't see it, you just don't feel it. You think things are kind of fairly aligned, if I may say so. It's kind of nebulous concepts. But like right now, I mean, obviously it sounds like you had a pretty strong view entering the year to pay it off handsomely. How would you characterize the opportunity set right now? Is a lot to do, or it's one of these ones, like you say, you're starting to get short and yada yada, or is it a time really not to make big moves at this point?
Yeah, so I think there's great uncertainty. I think let me answer with what I am doing because that should give you a clear, concise answer. I run a portfolio that takes 10% annualized volatility and also has a maximum drawdown of 10% if every position I have goes against me all at once. Um, I manage that with a budget, a risk budget. When I am highly convicted in across my entire portfolio with all of my trades, they aren't necessarily they're not correlated, but if I'm highly convicted, I run at 80 to 90% of my risk budget. I'm at 40% now.
Very
I
interesting.
also have a beta portfolio, which is my lifelong savings that I keep in a diversified set of assets across the globe. And normally, the normal run rate for that is to be 100% allocated with no cash. Currently, I'm 60% allocated with 40% cash. So, what I'm
You,
saying is
yeah.
that my alpha portfolio, which could be long or short, is uh, at half of my my high conviction risk rate um, risk budget, and my beta portfolio is heavy cash.
That speaks volumes. So, no particular order of these questions. Do you have any thought? Do you have any particularly strong views on energy?
I trade energy fairly actively, and the answer to that is I really don't. I have no position at the moment in alpha in oil. And that's all I trade, by the way. I only trade crude or crude equities, which I sometimes trade. Um, and the reason for that is uncertainty on the growth outlook. I would like to buy, that would be my preference from positioning and value standpoint and geopolitical supply and demand constraints, all those sort of things. I'd like to own it but I am a little bit cautious that this return to growth from a significant market growth slowdown is a bit overdone, and that would cause energy to suffer. I also think there's a fair chance that it's being, and I'm not much of a, in fact, I'm the opposite of a tin hat in terms of I don't generally believe that conspiracies are going on. I do think there is something going on with OPEC and the Trump administration that is keeping a cap on oil.
I knew there's a reason I liked you. By the way, I am a little bit confused at one thing, totally different. You have GoPen in your bio. So what's your connection to UPenn? Are you a grad or
I graduated there as an biomechanical engineer in 1986. My sister went there. My uncle was a professor there, famous professor there. My 3 out of my 4 kids went there. My nephew is matriculating in the spring, in the fall. Yeah, Penn's my place.
That's awesome, man. I'm one of the dummies. They always said this: the smart kids were the ones who were the undergrads. I went to Wharton to get my MBA. I'm 81, so I got a few years on you. Let's move on. So, Andy, I get in violent arguments with myself. I'm always doubting myself, always full of mistakes. And I was always like to ask myself what could go wrong, or what could the variant perception be, like where might I be wrong? All right. So let's say you come back before the end of the year, and I hope you will come back. This hasn't been too bad, I hope. Let's say you come back at the end of the year and things didn't quite work out the way you expected. I'm not asking you to predict a black swan. I mean, it's crazy. Tinfoil hat, you can come up with all these crazy ideas, but it's like throwing darts at a wall. But are the things that you're concerned about or could go wrong?
Right. So
Like so whether it's inflation, let me just finish it. Whether it's inflation going up, bonds going up, whatever it is, or we get a recession. If you were just of the things you've identified, I guess the known unknowns, to put it in Rumsfeld speak, not the unknown unknowns, but the known unknowns. If one of the known unknowns winds up turning the wrong way, what will it be? The economy stronger than you thought? We get a recession? Like, what is it likely to be,
right.
in your opinion?
So I mean, I'll only speak to what my current positions are because hopefully I can anticipate some of those shifts and change my alpha and beta positions. But assuming I didn't change my positions between now and then, my greatest concern would be AI delivers far more upside than expected, both for the stocks themselves because they're such big components of the indexes I trade, and for the economy in terms of productivity enhancements, and perhaps much more importantly for my beta portfolio, that the um, soft landing that we've heard of is achieved, and it allows both the fiscal and monetary policymakers to significantly ease without stoking inflation. In that case, assets will significantly outperform cash, and I have too much cash in my portfolio. So, easy policy that is allowable because inflation is offset by significant productivity enhancements is the thing that's going to hurt me the most in my current inventory.
So I always get confused with the directions, but it's really was it the right tail instead of the left tail, which is the bigger risk for you? You think?
Well, right.
I mean,
I actually think the left tail, I'm positioned because I don't expect those things to occur.
Correct. Yeah, correct.
And
Exactly.
so I am bearish equities, and I am
Correct.
not in assets because I don't think inflation is dead. And I do think there's going to be a growth slowdown, which is going to be particularly difficult for the central banks to manage through, while at the same time, the equity market struggles and assets
Got
in
it.
general struggle. And I think that's much higher odds than
Yep.
the alternative.
Got it. Okay, let's move to Faisy. Faisy, please unmute yourself. Do you have a question for Andy?
Yeah, hi Andy. Thank you so much for joining. Big fan. And thanks for putting on all the stuff despite all the crap you get from illiterate people on Twitter. But my question is, what would be worse, 10-year yields going over 5%, or us losing a couple 100,000 jobs over the next 2, 3 job reports, or Trump coming back and putting in, I mean, as angry as he is, more tariffs on different trading blocks. And there's also talk about, them imposing a digital services tax on our service providers because everyone conveniently ignores the services that the US provides to the rest of the world. In your view, what would be the worst or scenario? And just one thing I'd like to add, I work in technology with different firms, small industrials mainly, and I asked them, and they've already started increasing their prices from March, anticipating tariffs. They haven't showed up anywhere, but they've increased them in March, and they got excuse to increase them in April as well. So that hasn't showed up, but I've actually asked them if they've done that.
Okay, thanks,
So
Faisy. When you ask a question about what would be worse, the question is worse for what?
equities.
Equities. Okay, so to me, a 5% 10-year bond can be good or bad for equities. Um, if it happens because of deficits that don't promote growth, that are inflationary, and that need to be financed, and the rest of the world and the US investor rejects that type of investment and term premiums expand, that's very bad for equities. If, on the other hand, it's real growth due to productivity enhancement or without significant government spending, without significant easing of financial conditions by the central bank, if interest rates rise, that's perfectly fine for equities. Equities have risen a lot since 2020, the spring of 2020, when interest rates were at 1%. Now equities have, what have they tripled? And bonds are at 5%. That's the kind of thing you want. That's growth driven higher interest rates. So it depends.
But Andy, let me ask you this: as retail folks who don't have access to Bloomberg terminals, what do you watch to identify whether it's growth related or deficit related?
It's a real trick. There, no one knows. The price of a bond depends on inflation expectations, growth expectations, and term premium, which is the risk one takes for going out the yield curve. And with those three drivers all at play at the same time, you don't know. But what you do know is when stocks and bonds are both going up, it's not growth. When stocks are going down and bonds are going up, it's growth in price. I'm talking about, not yield. When it's a growth slowdown, and vice versa, if stocks are going up and bond prices are going down, yields are going up, it's a growth um, impulse. And so, what you have to do is you have to look at that both daily, try to make an assessment of what the drivers are and attribute back to your framework. And then over time, what is driving the price of bonds and stocks? And no one knows. It's it can't be quantified. There is no thing that says that's pure, that says what did growth expectations do today.
Thanks for the question. Andy,
Thank you, Andy.
before we go to another question from the audience, I have another one for you. And maybe it's not in your lane, as you say, but do you have any convictions or observations about particular sectors or particular countries? Or are you basically just dealing with indices so you don't get to that level?
I don't I follow sectors very carefully, and I would say that besides the energy sector, unlike what many will say, besides the energy sector, all sectors are rich. Like there's no great cheap sector in the United States to buy. As it relates to countries, I favor Germany because of its fiscal impulse over pretty much every country. And I like Japan and China over the United States.
Thanks for that. Waleed, please unmute yourself. You have a question for Andy?
Hi, Andy. Yes, I have a question. First of all, thanks for doing this. This was very good. So my question is, so you've said that you anticipate a growth slowdown, right? So, in terms of the data that comes in, right, the real-time data, the retails and claims, etc., how do you weigh different types of data?
Sorry, that was my fat finger. Waleed, please, you can speak now. I, by accident, hit the mute button. Go ahead, Waleed.
Oh, okay.
Yep,
I'll start
sorry.
again. I'll start again. Well, first of all, thanks for doing this.
Yep.
So it's been great. So I had a question around. So let's say you said that you're expecting a growth slowdown, and my question was, how do you rate the different kinds of data that comes in, right? So you get ISMs, you get retail data, continuing claims. Where would you look to identify that slowdown first?
Yeah. So this is a complicated question. And in particular, lately, the data, the data has been hard to interpret. But let me frame it to start with. All data is backward looking. All data is lagged. So you're not going to catch a turn. The market's going to turn before the data does. It never waits for the data. Now, in one particular day, a surprise to a surprising data can cause the market to turn. But the data, that is typically when the data is a surprise, a meaningful surprise versus consensus. But by and large, if you look at data, you're going to be lagging the market. So let's start with that. Then this other problem that's going on right now, and it's what they call soft data versus hard data. Hard data lags more than soft data. That's one thing because the hard data actually has to be collected. Soft data is are surveys that are impacted by things that make them good in that they're forward looking a little bit more than hard data, but bad in that they are influenced by things that are circular. So, for instance, we saw survey data get very weak very quickly, and the hard data has yet to catch up to it. It happened because survey data is led by stock market prices. So you're going to get weak survey data in periods of time when stocks are falling, and you're going to get higher survey data. So I actually think the next few weeks we're going to get pretty, and we got this with the consumer confidence number most recently earlier this week. You're going to get hot survey data. People are happy that the tariffs have been delayed, and now they may actually be ended. That is going to bleed through into the survey data. Also, survey data has become, in particular, less reliable as the country has become more fractured in terms of its politics. And so you see political differences in the survey data. So the answer is it's very hard right now, and because of these factors, and because of the and then the hard data itself is now impacted by something that people like to call the bullwhip, which is tariffs are coming. Let's buy stuff now before the tariff. Then the tariff comes and people don't buy. So you have a big retail sales boost, and then and GDP boost, and then and inflation boost, and then all of a sudden you have a hole where no one's buying anymore, because that's been whipping back and forth so much in the last 4 months. The hard data is going to be tough to interpret. Even though hard data is legitimate and lagged, it's useful because it's real. And so I use hard data, but I must say I'm weighting hard data a lot more lightly than ever before. Not ever before, certainly wasn't weighting it at all during COVID.
Is
And
this
so it's a matter of how much you weight that. And so, but my my process is not to wait for the data to be revealed to me and act. It's to anticipate the forces that are likely to change the data. And those forces lead me to a growth slowdown. Will it be confirmed? I don't expect it to be confirmed as obviously as it would in past years because of these factors.
Rob? Did you have something you wanted to weigh in on, Rob Isbitz? Maybe not. Okay, let's go to Ivan and then Hindsight Capital. Ivan, please unmute yourself. Ivan? I guess there's no Ivan.
Yeah, I'm here. Sorry.
Go for it.
Thank you for having me on. I really appreciate the opportunity. I just wanted to basically ask Andy if he's noticed any QE whatsoever in the previous, auctions that we had as of recent.
Yeah, so I've written a bunch of things in a heavily nuanced way about the reinvestment policy, which is causing people to believe that the Fed is actually buying treasuries when at auction they aren't. They are reinvesting maturing proceeds. But there is a nuanced bit to that suggest you go to my feed, and I'll repost it sometime today about that. The Fed's balance sheet is falling at 5 billion of treasuries per month. And roughly 20 billion of MBS per month. So QT is absolutely occurring at the moment. There's no ifs there's or buts about that. And it's draining reserves from the banking system at that rate. And so, uh, in a very, very nuanced way, it's doing it a little less effectively because of the way they're reinvesting. But you're missing the big picture if you think QE is happening. It's not.
Right. Excellent. All right,
Thank you.
let's move to Hindsight Capital. Hindsight Capital, you are the fellow with the best avatar on X. So I just love it when you come to speak.
I,
Hindsight, the floor is yours.
I appreciate that, George. Thank you very much. Andy, kind of a fanboy of yours, your auction grading scale stuff. I think it's great. You just throw a letter grade out there, and I don't know that a lot of people really understand what it means, but I do. Uh, I'd like for you to comment on two things. Who do you think the next Fed chair can be? And do you get kind of nervous that it would be an Uber Dove who might just kind of look past inflation and lower the policy rate? That's one. And then two, what's with this obsession of privatizing Fannie and Freddie, and what do you think the implications for mortgage rates would be? Thank you.
Yeah. I'm going to pass on the Fannie Freddie. I'm just haven't been following it that well. Was heavily involved back in the day with Fannie and Freddie and the impact of mortgages and mortgage convexity and their holdings and their inventory. Since they since then, I've just lost touch of what's happening. And your other question, sorry, remind me what your other question was.
The Fed chair in
Oh,
2020,
Fed chair.
Fed chair in
Yeah,
2026. Do you get concerned that it could just be a yes man for the administration?
yeah. You know, if Bowman had not been made vice chair, that was my pick for Fed chair. But I think it's my favorite pick right now, and the person I think that aligns best with what Trump wants is Waller. Um, I don't understand the fascination with um, what's his name? Wars.
Kevin Warsh.
Yeah, Warsh, right.
Yep. Yep.
Senior moment, sorry. With Warsh, because he's been fairly hawkish in all of his prior writings and commentary regarding what he thinks the Fed has messed up. But there is that fascination, and he is close to the administration. I, other than that, I don't have a strong opinion about who it could be. But of course, I am concerned about anything that would um, um, politicize the decisions on rates more so than they are today.
Thanks for the questions. All right, we're going to go to Rob Isbitz and then Gnostic. Rob?
Yes. First, going back a little ways, you talked about Trump's 2 terms as Dr. Jekyll and Mr. Hyde. Might you want to substitute going forward, Dr. Jekyll and Mr. Heckle? Just a suggestion. When I was looking up your site, one of the things that caught my attention was non-correlation, just that phrase, because I feel like finding uncorrelated assets or securities is such a big differentiator these days. Where are you finding them? And because I'm essentially substituting for Dilly, I will say, is Bitcoin one?
Yeah.
Tongue in cheek.
So when I think about when I talk about uncorrelated assets, I'm not talking about the assets themselves. I'm talking about the investment strategy. Um, Diversifying assets is important for long only investing. And the framework I use for that is making sure I have, and this is something I learned at Bridgewater during my time there and has been around for decades, going back to Harry Brown and his permanent portfolio, is looking for assets that respond to in different ways to various climates. Gold and potentially digital gold, though there is a bit too much speculative premium in that asset for me to consider it digital gold yet. Um, has unique properties and should be in every portfolio, every long only portfolio. And then some mix of pro growth assets, anti growth assets like bonds, pro inflation assets like equities, a little bit, I mean commodities, like tips, and anti inflation assets like bonds belong in every portfolio. And nowadays, because bond portfolios globally offer adequate yield, you can diversify internationally as well and diversify currency exposures. Now, you can add lots of different other diversifiers in there, but to get something that then reduces your aggregate risk, you need to find uncorrelated investment strategies. And those are what I call alpha strategies, and they involve market timing, and they're very hard to find and very hard to do.
Is that a bit more difficult now because indexation has really kind of taken over? Because does that also make the international equity markets a little bit more buoyant for you because they're not kind of indexed at the top, or should they
Yeah. So when you drop down into the equity market broadly, um, long short equities to me is, and that includes foreign versus US and sector, et cetera. is the most popular space in the world that has incredible minds that know companies in a level of depth I could never dream of. I spent 20 years on the equity floor at Solomon Brothers, and feel like I know a lot about equities. Traded them all my life, but man, I don't see. I have, even back then, and that was 20 years ago, before passive and indexation was the size it is now. I couldn't find an edge doing that besides extremely short-term, high-frequency trading. Um, I couldn't find an edge, but people find it. I'm not sure it's survivor bias and luck, given the number of people that do it. But I don't bother. I know that maybe some people can pick stocks. I know that I can't.
I've lived a somewhat parallel life, and I concur. George, want to move on to some of the folks?
Yeah, Rob, could you please mute your mic? It's got a lot of static in it. Okay, we're going to Aaron. Aaron, please unmute yourself. Do you have a question for Andy? Aaron? Can't hear you, Aaron. Maybe you need to drop down and come back. All right, Andy, we've been doing this, so we've been at for an hour and 10 minutes. You're really generous with your time. The rocks are tremendous, so I really hope you'll come back again. And this has been terrific. Gnostic, I see we have all right. Gnostic, you're the cleanup batter always, or you're in the hole. You're always batting ninth or whatever. So Gnostic, I'll give you the last question. Go for it. Gnostic, can you hear us? Rob, can you hear us?
Yes, I can, and I'll say pinch hitting for Aaron effectively is what he was doing, which is something that never happened in the major leagues.
All right, I don't know. We have Andy. This app has been so glitchy later. It's just of late. It's just crazy. So, I think we should quit while we're ahead. This has been an awesome space. Yeah, Andy. I hope we can get you back sometime later this year. This has been awesome, and we've all learned a lot. So I want to thank you for your time, Andy.
I appreciate it. I was able to clarify some thoughts I had.
No, for
as well.
sure.
So
It's
that's all.
great. Hey, thanks so much. Good night, everyone. See you
Good night.
tomorrow.
Thanks, guys.
Take care. Bye-bye. Bye. Bye.